Hey everyone, and welcome back to another innovative investment idea. My name is Dave, and in today's video we'll be taking a look at Nordic American Tankers and how it has come into focus in recent times due to the oil crisis of April 2020. But before we get started, don't forget to hit the subscribe button if you're new to the channel to get more stock market content just like this. Nordic American Tankers, ticker symbol NAT, November Alpha Tango, operates a large fleet of 23 tanker vessels primarily used to transport oil from point A to point B. The company has been around some 25 years, having been incorporated in 1995, and its stock price has had a rather volatile history, uncoincidentally reflective of the underlying price of oil itself. Apart from a few amazingly profitable years between 2004 and 2010, when oil prices were trading at historical all-time highs, ranging from $80 a barrel and peaking at about $150 a barrel in 2008, levels that have never been reached since. The stock price of NAT has mostly been unspectacular and even lackluster, pretty much in a state of steady decline since the turn of the decade, despite the longest and most rewarding bull run in the history of the stock market over that same time span. So the question is, why discuss NAT now then, a stock of seemingly marginal relevance? Interest in the stock has in fact increased dramatically in recent times, sparked predominantly by the oil crisis that shocked the world economy in late April 2020, when the world essentially ran out of oil storage capacity overnight. Since that time, NAT and many other tanker companies for that matter have been called into action to provide relief in the surge in oil storage demand, as they essentially have become glorified floating storage providers instead of specialists in the actual transportation of the commodity. Now, before I give you my specific thoughts on whether the stock is a buy, sell, or hold here today as a result of the new landscape we find ourselves, let's first rewind back to what caused the oil crisis in the first place. Like most of the economic issues we face here today in June 2020, there was a chain of events triggered ultimately by the pandemic. As the US and essentially all countries across the world began to mandate shelter in place and lockdowns were instituted in late March, the demand for both air and car travel plummeted as industries and consumers alike were no longer buying oil to power the engines of their respective vehicles. To help quantify the drop in demand, according to a study by the US Energy Information Administration conducted in 2019, transportation of both people and goods accounted for approximately 30% of total energy consumption in the United States, and of that 30%, refined oil and petroleum products accounted for over 90% of transportation sector energy use. Add to that any number of manufacturing plants and industrial use cases across all sectors, such as automotive and food processing, being shuttered due to stay-at-home orders, and it's easy to see how significant in scale the drop in oil demand might have been. Now, in an ideal world, to keep the balance of oil production and usage in equilibrium, with demand so low, supply would also have to be reduced. Unfortunately, that was not the case. At the same time as all the aforementioned was unfolding, a standoff between OPEC, the organization of the petroleum exporting countries, and other nations was bubbling over. And there was just an air of general political hostility since every nation on earth was looking out for the best interests of its own citizens and economy in the wake of the pandemic. Large oil-producing countries such as Saudi Arabia, Russia, and even the US did not slow down production at all, and in fact the opposite occurred. A disagreement to cut production eventuated, with each player accusing or suspecting the others as being self-serving, which actually escalated to an all-out price war, as we can see in this article dated March 6th, predominantly ensuing between OPEC and Russia, leading to an actual ramp-up of oil production. As we now know, this resulted in a huge glut of supply that unsurprisingly overran demand and in turn led to an astronomical increase in the need for storage since there was so much excess. OPEC and other nations would ultimately agree to cuts roughly a month later on April 13th as participants began to feel the price squeeze, but even with diplomatic agreements in place, the physical production declines would not come into effect until later in May due to implementation lead times. This meant that production would still be allowed to go unfettered for at least 2 or 3 additional weeks, and in retrospect would come much too late. The demand for storage came to a head on Monday, April 20th, only a week after the OPEC agreement, when the price of oil actually hit an historic all-time low of negative $38 per barrel. The lack of viable storage options from the oversupply resulted in a panic sell-off session where the price of the futures contracts dropped by an eye-watering 310% intraday, and holders ended up ceding possession of contracts to simply avoid collecting, knowing full well that they had absolutely no place to store it. As a quick note on oil pricing, the spot price is essentially an abstraction only. When it plummeted to negative $38 a barrel on that fateful day in April, we can be sure that many actual barrels of oil in physical markets were not traded at that seemingly irrational price, though some were no doubt offered at prices below zero. The plunge was in the price of a hypothetical barrel of crude oil represented on paper only, captured by the futures contract, which is a derivative traded in financial markets like the New York Mercantile Exchange. You might already be familiar with an option and not a futures contract, so as a quick explanation, the difference between an option and a futures contract is that an options contract gives an investor the right, but not the obligation, to buy or sell the underlying at a specific price by a certain point in time. But in stark contrast, a futures contract requires a buyer to purchase and a seller to sell the underlying commodity on a specific future date. To provide further context, the underlying commodity of the negative futures contract, which has been discussed to this point, is for a type of oil known as the West Texas Intermediate, WTI, otherwise known as Texas Light Sweet Crude Oil, for delivery specifically in May of 2020, so a couple of weeks after the April 20th exercise date. There are many other types of oil traded around the world as well, such as Brent, which is a particular benchmark used outside of the US, and although they follow WTI prices downwards, do not actually hit negative territory. So when people in the future refer to this specific oil crisis of 2020, they will be generally referring to WTI crude oil, even if it is not explicitly mentioned by name. The back half of this story, which will eventually circle back to Nordic American Tankers, is that when the oil prices dipped to these incredibly low and even negative prices, it created a rare situation in commodities trading known as contango. In layman's terms, contango is when the price of a commodity is higher in the future than the current or spot price. So in the case of WTI during April, there was significant contango, sometimes even referred to as super contango, because although the May contracts could be acquired for negative prices, each and every one of the subsequent months was still trading at positive, but more importantly, at increasingly higher prices so that traders could purchase simultaneously contract months or even a year in the future in addition to the May contracts to lock in a certain margin. Obviously, the traders would need to address the elephant in the room by somehow solving the lack of readily available storage, but if they could get paid to take possession of oil by producers, offload the burden of storage by paying someone else a premium to store the oil on their behalf, and finally sell it in the future at the guaranteed higher price to which they had already locked in, they could create an arbitrage opportunity, assuming the cost of the storage premium was less than the margin. Or in the specific case of speculators, simply get paid for taking possession of oil and offloading it at an undefined point in the future when oil had risen to a sufficiently high price. As we already discussed, there was already a lack of storage due to the excess generated by OPEC and other nations, so this actually drove many, therefore, to think about an alternate and potentially unconventional storage solution, oil tankers, whose primary purpose is obviously to transport oil and not store it per se. As recently as February 2020, so a month or so before the pandemic gripped the entire world, the going daily rate to hire a large tanker was about $25,000, but because of the contango situation and many speculators wanting a piece of the action, the going rate skyrocketed to somewhere between $200,000 to $300,000 a day, about 10 times higher than usual. This resulted in two key things: vessel scarcity, since there were a limited number of oil tankers in the world and each one would only go to the highest bidder, and secondly, companies like NAT, who had wallowed in obscurity for a number of years, suddenly became relevant and in demand. NAT wisely took maximum advantage of the situation by requiring newcomers to lock in longer-term contracts of between 6 to 12 months at the inflated daily rates, guaranteeing an enormous steady cash flow for the tail end of the first quarter, but also leading into Q2, Q3, and potentially even Q4. We should keep in mind that since NAT's fleet consists only of tankers in the Suezmax category, each with a capacity of roughly 160 deadweight tonnage, they don't actually command the upper end of the going rate, which is mostly reserved for VLCC or ULCC ships. As we'll see shortly, the going rate for Suezmax class ships is actually closer to 50,000, which is still an exorbitant fee no matter how you spin it, and if you multiply that across 23 ships, it equates to well over $1 million a day of revenue for NAT. Regardless, dozens of oil tankers from all over the world, including some of NAT's 20-odd vessels, began to congregate off the coast of Los Angeles, setting themselves up to be readily available to both load and unload oil and simply just float and remain stationary in the interim. Opportunistic stock traders, and not just commodities traders, took notice of the developing situation as early as March, correctly identifying that all of the oil tanker companies' profits would increase by orders of magnitude given their astronomical daily rates, and bought company stock accordingly, thinking they could get a piece of the action as well. For NAT in particular, while the price did climb precipitously from around $2.50 a share and peaking at $9 on April 28th, culminating in the heightened trend surge we saw earlier, because it has now come down to about $5 a share, NAT represents both a sore spot and a point of interest for many investors, especially those that got in near the highs. A factor which undoubtedly added fuel to the fire was the hype around NAT on YouTube just before the peak, when a multitude of influential channels began advocating the stock, including one of the biggest, Financial Education, with its 500,000 subscribers. Jeremy released a video on April 22nd to explain his bullish thesis on NAT and the oil contango situation at large, which undoubtedly swayed many retail investors to hop on board as well. The question for those then that didn't exit at the $8 or $9 levels is whether to hold, sell, or perhaps even buy more of the stock in order to average down the cost basis. Jeremy has released one or two additional videos since addressing NAT initially on his second channel, with the message that he would not be selling his position anytime soon, despite this downturn in the stock price. And before I tell you my thoughts on what investors should do moving forward, let's first have a quick look at NAT's Q1 results and the company's plans for its dividends for the upcoming quarter. As expected, NAT reported a massive net profit for Q1 2020 of $40 million, which in fact decimated the entire profit it made during all of 2019. It also reported a daily average charter rate of about $44,000 a day, keeping in mind that through the first 2 months of the quarter, it was still operating on deals it had negotiated at the pre-pandemic rate of $25,000 per day. It also paid out a fairly healthy 14-cent dividend, representing about 3% of the stock price, or an annualized yield somewhere in the neighborhood of 10%. On the surface, these look like exceptional numbers, which might lead some investors to ask why the stock price did not leap significantly upwards from the Q1 report. The short answer is that Wall Street had already priced in much of the good news, and in general, for stocks to either go up or down significantly after reporting, it has to deviate substantially from analyst expectations, which in the case of NAT was more or less in line and thus offered no real surprise. In this vein, if we look at the projected Q2 numbers, we see that it should enjoy a more robust daily rate of 50,000, almost 20% higher than Q1 rates, and with an operating cost of only $8,000 per day per ship, we arrive at a projected net profit in the neighborhood of 90 million. But unless NAT can report substantially healthier figures than 90 million, the stock won't probably move even after what looks on the surface to be double what they earned during Q1. If we quickly shift over to the announcement that the dividends for Q2 are expected to be 42% higher than the 14 cents paid out during Q1 at 20 cents a share, due to the much higher projected net income, it really does make this stock attractive from a pure passive income perspective. And while we won't examine the financial statements in this video, it's also worthwhile noting that NAT has 50 million in cash and more than double its liabilities in assets, meaning that it is in a sound financial position to continue operating as usual without any liquidity concerns, especially given the relatively low cost of revenue comparatively to the revenue itself, as we've already seen. So finally, summing up and returning back to my own thoughts on the stock. If you already got into NAT, I would say it's a definite hold until we get some indication that Q2 results will either be significantly better or worse than the 90 million projected. However, if at any point the stock price shoots up substantially, say from a crash in oil prices or a second wave of the pandemic hits, once again suppressing global demand, I would not hesitate to seize the opportunity to sell out and enjoy any capital gains, and deploy the proceeds towards a stock with better long-term opportunity, such as growth companies Alteryx or The Trade Desk, which I have previously analyzed and created videos for, and whose links should be popping up as a card in the top right hand corner now. Investors should also keep in mind the upcoming key date of August 28th when the stock goes ex-dividend for Q2, meaning that an exit should potentially be timed after this point for those keen to get out, so the healthy dividend is not sacrificed. There also seems to be substantial technical support at around the 450 level, so unless there was really bad news from either the company specifically or the industry at large, it will probably remain above that point for the moment. Additionally, if investors had originally purchased NAT with the intent to keep it as part of a larger dividend portfolio, then I would suggest it is actually a decent idea to hold onto the stock for the long haul, as the yield is quite healthy even compared to dividend-focused stocks and even aristocrats, and it seems likely that the company will continue to operate under the current market conditions for the foreseeable future, as it might potentially be 2022 and even 2023 before we start to see society returning back to something resembling a pre-pandemic state, and there no longer arises a need to store oil at sea. In fact, I would argue that investors should reframe how they think about NAT, as it is a pure dividend play at this point in time, and not a speculative high capital growth opportunity it presented itself to be as recently as a month or so ago. If you are on the sidelines or looking to get in for whatever reason, I would say tread with extreme caution and perhaps weigh the prospect of other stocks with better fundamentals or growth prospects, as it is definitely possible that NAT has already run its course as a quick win, especially at the current price. In all cases, given the uncertainty still surrounding the direction of the oil market, however, this stock should still be on everyone's radar until further notice. That about wraps it up for this video. Don't forget to hit the like button if you found this video helpful or insightful, and drop any other questions, thoughts or comments down below. Please also consider subscribing if you enjoyed the content, as it would really help to raise the profile of the channel. Before I go, you can click on any of these 4 videos for some of my other thoughts or insights of the market as well. As always, thanks for watching, and I'll see you in the next one.